Cool. So today we're talking about comps, which is our first valuation method after covering accounting and enterprise value. I need to put up that video from last time. I'll get you that this weekend. You kind of need it for this week, but the last week was not too complicated, so you should be fine. Although I did hear Eric stayed for 2 hours. But what he said, y'all went over cap IQ in much greater depth than I expected you needed to, / was going to go over with you, but it's fine. Cool. Right. So real quick, what are comps? They're like pretty easy to explain, so most of it will be on Excel today, but just to give a brief background about comps, so they're one of the 3 primary valuation methods, and basically it looks at multiples in which similar companies are traded at, and that'll be fleshed out more. So, but like in terms of intuition, so first, how would you value your house? So as you can see from here, there's a couple ways. So first, to look at similar houses to get a good estimate, and also it will be very wise to focus on houses in the same or adjacent neighborhoods. So clearly, it wouldn't make a lot of sense to look at the same house in California with the most like absurdly high housing prices in the United States versus some random place in some like Texas, because the difference will be like on a scale of like 5 to 10 times. But if you're looking at the house right next to yours, you can kind of see the accurate gauge of what your house will be worth if you believe the value of the other house is accurate. And specifically, factors you would consider in your house is like location, the area, how big the area is, how nice the property is, and what is in your inside your house in terms of amenities. Cool. Great. So basically, you want to do this in a similar fashion for companies. So how do you generate an appropriate list of comparables? So on the job, comps are usually handed to you. So basically, this summer when I was working, like when we're looking at some company, my like MD would tell my VP, who would then tell my associate, who would then tell me what to do. Yeah, this is a long line, but basically, like these people have been in industry for like decades, so they know obviously what to do in terms of what are good companies to compare your company with. But other than that, there are also internal databases that a bank or a firm would develop over time that you could just easily pull out of, and also updates with their really cool dynamic tools. So that's really easy. But for us students, there's a couple things. So first, databases. So Bloomberg, FactSet, Capital IQ. There's like a quick comp section, although you should definitely vet them. And then second, equity and industry research reports, because in a lot of them, the research analysts will talk about different competitors as well as different companies that you might want to compare it to. And they also might run a comps analysis that you can just pull out of and see what you want in terms of it. And for those things that are not readily available, a lot of research can be done on your own for that. So there's a few aspects for companies you want to look out for. So there's like the sector / subsector. This one's pretty obvious. You want to compare like a grocery store to another grocery store, not a grocery store to like a cruise line. Products and service offering. Again, like for example, like different companies might be in the same sector, but they might offer different goods. For example, like if someone sells cereal and the other person sells like granola bars, even though they're both food products, they might not be exactly the best comparable given the difference between the products that they offer. And there's geography. A company based in China is obviously different than a company based in Canada. So ideally, you want to find similar companies in the same like headquarters. Size, again, like small cap companies tend to trade at higher multiples than large cap companies just to account for the growth rate. And finally, distribution channels. So even if 2 companies are based in the same location where they follow the same tax laws, etc., one might have its operations more geared towards the West Coast and the other towards like East Coast versus urban and rural, etc., that might affect how these companies are valued. So keep in mind there's no perfect comp. You can see that these sets here are pretty similar, like Home Depot and Lowe's, Coca-Cola and Pepsi, Pizza Hut and Domino's, but there's no 2 companies that are exactly like. So the idea is to get like a useful estimate of their value, but obviously no model is perfect, which accounts for the variation in terms of what they're trading at. And those factors, those are like guidelines, and you want to try to match as much as possible. But in the sense that like each company is different, you want to try to match as close as possible. But there are definitely cases where it will be different, especially in terms of size or distribution channel. But as long as they're reasonably similar, it will be useful to guide your analysis. Cool. Nice. So comps uses a multiples approach. So basically, even if we were to find businesses that are extremely similar in terms of operations, there's still the purpose of comps is kind of standardize several factors, and most notably is size. So therefore, comps is a relative valuation approach because it allows us to compare companies in relative terms rather than absolute. So basically, you can see from here, this is just a simple example from two really basic businesses. So basically, Phil's Lemonade Stand generated $5,000 in sales last year. Eric's Lemonade Stand generated $10,000 in sales last year. And the kids in the neighborhood thinks Eric's business is worth $100,000. So therefore, how much do y'all think Phil's Lemonade Stand is worth? Cool. Does anyone want to walk through why it's worth $50,000? Wait, what do you mean by that? Correct. So yes, that's exactly the intuition behind this. So basically, with comps, you're willing to pay a certain amount of money, which is the value of the company, per some metric that the company does. So Spencer is exactly right. You see $100,000 of like people think Eric's business is worth $100,000, and Eric generated $10,000 in sales. Therefore, they're willing to pay $10 for every dollar of sales. So if you apply that logic to Phil's Lemonade Stand and Phil generated $5,000 in sales, then if you're going under the assumption you're willing to pay $10 for $1 of sales, then Phil's Lemonade Stand is 5,000 times 10, which gets you to 50,000. Is that clear to everyone? Cool. So then we go to the advantage and disadvantage of comps. So first, for pros, it's rather easy to calculate because the data is readily available. You're mostly using like numbers are given to you that exist, so there's a lot of like inputs that you have to put in. So especially for public companies in which they have to disclose everything under SEC guidelines, it's really easy to find data to like put into your analysis. Second, it usually provides a reasonable range of values because it's grounded in market realities. Because theoretically, like this is more towards like more theory, but like theoretically, if people believe market is efficient and people strive to trade until you get to the true value of something, that means that like the market at any given time will have a pretty helpful guide towards what things are worth. And then third is not dependent on a set of assumptions, and that could be arbitrary depending on the person running the analysis. So for example, with a DCF or another like type of analysis that involves you making assumptions on the company's future performance, this one, comps do not really rely on that. However, there are also a few disadvantages to comps that you have to keep in mind. So first, it's unhelpful when few true competitors exist. So a good example is actually something like Costco. You might think like Costco has a bunch of different competitors, but Costco has a very different business model because they focus on a membership subscription fee and have raised thin margins. So it makes it really hard to find a good comp in terms of business model to Costco. So it's kind of hard to run a comps analysis with companies like that. It can be difficult to find companies that are appropriate to compare. I guess this kind of ties in with the first one. And then finally, it could be influenced by temporary market conditions that may not be descriptive reality. So for example, if something happened to a company that really impacted them, that might make when you're comparing your company to the other company, that might distort your value as well. So if your comps are overvalued than they actually should be, then it makes your company seem overvalued. If your comparable companies are undervalued than what they actually like should be in like real monetary terms, then it will also make your company seem less valuable than it actually should be. And finally, here's some common multiples. So there is generally two types of multiples. So there's enterprise value and equity value. So you can see here that the one in the numerator is the valuation metric, so either enterprise value or price, which is just price per share, which is a symbol of equity value. And then you have the earnings metric on the bottom. So EBITDA, earnings before interest, taxes, depreciation, amortization. EBIT, which is just your operating income. Revenue, which is just your top line sales. And for equity value, earnings is just another term for net income. So you can see here, one thing to keep in mind here is you need to match your valuation metric with your earnings metric. So what I mean by that is, for example, let's just take EV over revenue. So revenue, when you generate revenue, some of that goes to you, so the equity holders, and some of that goes to the debt holders because interest expense is paid off from your revenue. And it also flows into retained earnings once you get to net income. So you can see that enterprise value is the value of equity plus debt, so which is why it makes sense to have EV over revenue. So similarly for equity value, it's just price per share over earnings per share, because price per share is just the price per common stock that's being traded on the market, and earnings is net income. So you can see that net income is after you've deducted your interest expense. So that is already, so the amount of money you generated available to your debt holders has already been taken out. So therefore, earnings or net income is only available to equity holders. Thus, you have price over earnings. So it wouldn't make sense to have like EV over net income because, again, enterprise value is the value of debt plus equity, but your net income is the amount available to only your equity holders. So that wouldn't make a lot of sense. So that's something to be aware of. The last part is really important. People will ask you during interviews about that. So is any of that unclear to anyone? All right, cool. I think that's the last slide. So as soon as it loads. So can everyone open your Excel and go to the comps practice sheet? Let me know when you all are there. It's the separate Excel file when I send out that email. But also, yeah, open the stuff in a zip file as well. Well, that's just more for your reference. I'll be showing you. That's just all the filings we use for this exercise. You don't have to open that. I will be opening stuff and showing you where I got some numbers on the screen here. But yeah, just the Excel sheet. Cool. Everyone have it open. And click Enable Editing. It might just be a Windows thing. I think Macs are better for antivirus. All right, cool. So this is like not exactly the best layout. It also doesn't look too good, but essentially it's good. It provides a pretty good exercise for you in terms of calculating comps. So again, going back to our lemonade example, the lemonade stand example was basically calculating something with EV over revenue times a revenue metric. Here, the two we're going to use are EV over EBITDA and price over earnings. So one that's based on the enterprise value approach, and the other one based off of equity, an equity value multiple. So basically, going back from last week, we're looking at Kellogg's, everyone's favorite cereal brand. And then we're going to have a few comps. So General Mills, Mondelez, and J.M. Schmucker. And Kellogg's is not just a cereal company. They also provide snacks and other goods and other foods. So these three companies are also pretty similar in the sense that they provide food products, have their own brands, and sell like different snack goods as well. So I have already provided you the EV over EBITDA and PE of Mondelez and J.M. Schmucker, courtesy of CapIQ. But we're going to calculate out the stuff for General Mills. just to show you like how to like really spread comps instead of just taking all the database. Great. So now why don't we go to General Mills with the GIS tab. Cool. So for this, I'm just going to walk you all through this. So stock price as of yesterday is $50.86. And so we're going to use this obviously for the equity value calculation. Again, equity value is market cap, which is your current share price times the number of shares outstanding. So last week we had a very simplified version of this. But for this, normally you want to calculate your fully diluted shares outstanding. And sometimes databases don't calculate it correctly. So which is why, like, if you want your perfect and most accurate analysis, you want to do it yourself. So essentially, how you get to fully diluted shares outstanding is you take the common shares outstanding, which is the proxy we used last week, and then you add back all the forms of dilution that eventually to get to your fully diluted shares outstanding, which is what FDSO stands for. Cool. So first, let's find the common shares outstanding. So basically, if you go to the SEC website for, I should just show you real quick. So if you go to the SEC website for General Mills, which is GIS, you can see that as soon as it loads, there's a bunch of documents. But the most recent one is actually the 8K. So if you look at the 8K, which we have right here, that's 10K, sorry. You can see that this is the most recent document, and they actually have a share count right here. Yeah, so there were 507 million shares of common stock represented either in person or by proxy. So this is actually the most recent share count of this company instead of on the 10Q or the 10K. So which is why we're going to use this number for common shares outstanding. So if you go back to the Excel, you want to type in 507 points. So we're going to put everything in millions. So 507.554812. Cool. Yeah. So again, most analysis is done in millions. So instead of having to curve everything back and forth, we just write everything in millions, which is why we're turning the 507 million into 507 point some number, which gets you to 507.6 when we round. Cool. So from here, that's your basic common shares outstanding, and then you want to factor your dilution next. So there are three main forms of dilution, two of which we have here. The third one isn't so relevant because not a lot of companies have it. But basically, we have restricted stock units, you have your stock options, and then you have your convertible debt. So convertible debt is the one we're not going to talk about. But basically, convertible debt is when you have debt for debt holders to participate in upside of companies. Some debt have the option to convert into shares of stock. So debt holders can also participate in the upside. But also it makes it so that because they can choose to stay as debt, you limit a downside if the company goes bankrupt. So with convertible debt, typically your coupon or like the interest payment you make to the debt holder is lower because it counts for the value of the optionality that they convert into shares. And typically in the contract, they will state how many shares this debt can be turned into. So that basically allows you to just take the easy factorization, find the number of shares, and dilute it. So that's not really common, so we're not really going to put this on this Excel sheet. But the two things that General Mills does have is restricted stock units and options. So typically the 10Q does not have this information because the 10K is the most detailed thing, and most of the time they don't have it on the 10Q. So which is why for this piece of dilution, we actually go to the 10K, even though there is a more recent 10Q for this. Yeah.
What is restricted stock units?
Yeah, so we will go over that right now. So let me look it up. So restricted, it's somewhere down here. Cool. So basically, if you what you saw there was where did that go? Right. Okay. So here is the restricted stock units. So basically, this goes to the stock-based compensation piece of how companies compensate their employees. So essentially what that means is because you can get compensated with cold hard cash, or this is more common for tech companies, but because when companies don't want to spend money to pay their employees, they give them stock. So normally when you have restricted stock, there's like kind of like incentives to working for the company a long time, and basically they only vest if you work at the company for a certain amount of time. So for example, like if I get hired by like Apple or something, I might be given restricted stock as a part of my compensation. But
you can only like access it if you stay for a certain
yeah, so part of the employment contract would be if I stay for 3 years, at the 3 year mark, I will be given stock that I can sell, and that's part of my compensation.
Oh, and then when you get it, it's off. But
Correct.
When you're waiting to get it, it's called.
Correct. Yep. Is that clear to everyone? Right. So you can see here. So this is in their notes, the note 11 of their 10K. This is underneath the section 8 about like financial statements and supplementing data. So you can see that this is the breakdown of their stock-based compensation. And if you look here under the restricted stock section and RSUs, you can see that as of May 2018, which was their most recent 10K, or sorry, they started with this amount, so this is their non-vested as of May 2019, which is their most recent 10K. So essentially, if you see this, there's granted, there's vested, and there's forfeited, but the most important thing you want to see is non-vested, because everything else is factored into the current share count. So like the stock that have been vested is already part of the common shares outstanding that we found earlier. But the non-vested means it has not been given to the employees yet, so that's why it's restricted. So this is the amount that we need to add back in order to account for the full dilution, because this is the total possible number of shares that could be available. It just hasn't been given to the employees, but the companies need to account for that. So you can see that this is 4272.3 thousand, so it's 4.2723 million. So going back to the Excel, you get 4.2723 million, which gets you to 4.3. So, and here you can see the reason why we didn't take this into account last week, because again, you can see this is a very small number as compared to 507 million. But for the sake of accuracy and to get the most accurate information, you want to include the 4.3 million dilution in your share count. Great. So then the other piece of stock-based compensation is your options. So going back to the top part of section 11, you can see there is stock options. So similar to the similar to the restricted stock units, for a company that you work for may also give stock options to employees. So basically, what an option is, there's basically, if you look here, so you want to look at the exercisable price. So the exercisable price is there's 14,219,000 options outstanding, which is 14 million, and then it's a weighted average exercise price per share at $41.80. So what this means is that the employees have the option at any point in time, because they're exercisable, to be like, okay, I want my shares, and I'll purchase them at $41.80. So what that means is there is a potential for all these shares to suddenly be purchased at $41.80. And so from this, we use a treasury stock method, which I will go over now. So you can see that, so exercisable options is 14.2190. So this is 14.2190 million shares. Right, cool. And then you have weighted average share price of $41.80. So this is 41.0. So that's your weighted average share price. So you can see here that theoretically, we assume that all of these options are now exercised. Basically, every employee who holds one of these shares goes up to the company, goes up to COGS, and be like, I want my shares now, and I'll pay $41.80 for it. And note this only happens because the weighted average exercise price per share is lower than the current stock price. So this is what we call in the money. So in the money just means weighted average price per share is less than a current share price, because the vice versa is called out of the money. For example, like if the weighted average exercise price per share was $60, then obviously no one would exercise their shares, because if the stock is only worth $50.86, it makes no sense for employees to give the option to use their option of buying it for $60. Yeah.
Do employees technically buy it, or do they just like get the stock for $41.8?
No, you have to buy it. So you take your.
So they take the salary and then.
Correct. You take whatever cash you have sitting in your bank account, you exercise your option, you pay $41.80, and now you own this share of stock. Except because that share of stock is worth $50.86.
So, but it's more like for like incentivizing employees to like want the stock to perform well. Than
That's also
Okay.
Yes.
So can you buy the options and then theoretically sell off all the options that you bought for like $9 profit on each stock?
Well, at this moment in time, your option is worth at least like $9, whatever difference between that. So yes, you could theoretically sell that option, but we just know that this option is outstanding and exercisable. So I don't know if that answered your question.
Like, so because it's exercisable, like you can purchase this option, right?
Yep.
Okay, so you purchase the option and then you decide to turn around and sell it.
Sure.
Thing that you can do.
I'm not too sure in terms of like company-specific employee stock options. That I'm not too sure about actually. But like regardless, even if you can, the option still exists. But like I don't know the difference between normal options, or I mean like because normal options you definitely can, but since these are employee stock options, I am not too sure if we can do that or not. Yeah. Great. So then you have $41, and so basically again, theoretically you have 14.2 million exercisable options. Everyone decides to exercise them, and basically they will buy them for $41.80. So basically you have this times that. So basically 14.2 million shares are bought from you for $41.80 each. So basically number of shares times price per share, or the exercise price per share, is the amount of proceeds the company would get. Cool. So now we have 14.2 million extra shares. But the reason why this is called the treasury stock method is treasury stock is when you repurchase shares, and those shares go into like your treasury stock, aka you basically retire them, and they disappear from like diluting your earnings. So from here you would repurchase. So using that's $594.4 million in proceeds, you want to repurchase as many shares as you can. So you can see here that the stock price is $50.80. So then you would divide 594.4 by the current share price on the market. So therefore, you would be able to buy back with your proceeds from this people exercising their shares. You will be able to buy back 11.7 million shares. If any of that didn't make sense, feel free to ask. Like this is probably a more confusing piece of the treasury stock method. Okay, cool. So basically, 14.2 million shares entered the total share count because people exercise their options. Then you assume that you can repurchase 11.7 million. So therefore, the total diluted effect would be 2.5 because 14.2 minus 11.7 is 2.5 in terms of the dilution on your total share count. Cool. So now you have the common shares outstanding. You want to add the unvested RSU. And then you add the diluted effect from the options. So therefore, your fully diluted shares outstanding will be 504.4. FDSO stands for fully diluted shares outstanding. FDSO. Cool. Yeah, I should have wrote that out. Yeah, so fully diluted shares outstanding. Right. So this is just, you can see the bottom part is just the calculation we did last week for enterprise value. So the only thing to highlight here is if you F2 equity value, this is your stock price times your fully diluted shares outstanding, which gets you your equity value and market cap. Right. And then you have you add your debt, you minus your cash, then you add back your preferred stock and non-controlling interest to get to an enterprise value of $40 billion, $276.1 million. And yep. And then from here we use that to calculate the multiples. So here I have provided the last 12 months net income and last 12 months EBITDA for General Mills. So essentially from there, you have PE is, so price over earnings it's an equity value multiple. So therefore you take this number, your $26 million in market cap, and you divide it by your net income. And that gets you 13.9. Sorry, do you have a question?
No.
Okay, cool. And then you have your EV over EBITDA multiple, which is your enterprise value divided by your EBITDA, and that's 11. All right, yeah, so that's how this stuff works. Sorry. Oh, wait, what number did you delete? Oh, LTM EBITDA, yeah. Okay. Right, so and just one quick note about LTM net income and, oh, sorry. Right, so just one quick note about these LTM numbers. I got them off of CapIQ, but essentially this is just using the last 4 quarters of net income or EBITDA. So for General Mills, their fiscal year ended in May, so they had 1 extra quarter of information. So what this means is just you take Q1 of fiscal year 2020 and the last 3 quarters of fiscal year in 2019, and that's their LTM net income and EBITDA. So the reason I feel comfortable using CapIQ for this is because CapIQ and other databases are very good at scrubbing data. So those are more trustworthy numbers on CapIQ. However, the reason why we want to calculate FDSO is the databases aren't very good at taking the options in their exercisable share price and getting to fully diluted shares outstanding. So the more complicated calcs, they're less accurate. So in general, for the most accuracy, you want to do this yourself. But in general, for this, you also want to do it yourself. But if you're short on time, then it's better to trust like numbers that they scrub off of 10Ks than numbers that you actually have to go through extensive calculations. Yeah, and since General Mills is a pretty stable company, another company might actually have multiple tranches of options. So what that just means is that if you look here on this options, you can see that there's a weighted average share price and also an options outstanding. However, some other companies, most notably tech companies, might have multiple types of options with different weighted average exercise prices. So you basically have to do the same thing I did earlier multiple times to get the dilution for each bucket of options, because they might have different exercise. So you have weighted average exercise prices, so you get different proceeds from each bucket to repurchase shares. But the logic is basically what we just went over. Right, and we don't have that much time to go over the one on Kellogg's. I think y'all get what we all just did. So just to show y'all real quick, so for Kellogg's, we had the same deal for unvested RSUs. However, if you notice on their exercisable options, they weighted average exercise price as $63, but the stock price as of yesterday is $61. So therefore, we call this out of the money. So therefore, there's no dilution from options, because no one in their right mind would want to pay $63 to exercise an option on something that's worth $61.43. So therefore, there's no one will exercise their options. We call it out of the money. So therefore, the dilution is just their common shares plus their unvested restricted stock units, and that gets you to 342.3 fully diluted shares outstanding for Kellogg's. Cool. Does that make sense to people? All right. Yes. Great. So then we get a comps. So for this, you want to fill in the remaining sections. So we will set this equal to, so we calculated EV over EBITDA of GIS. So this is equal to, so you go here, and then if you scroll down to GIS, your EV over EBITDA multiple here is 11.0. So you just want to click that. So yeah, go down to GIS tab, you click that, and that gets you to 11.0 times. You can also just manually type it in equals GIS exclamation point C29, but to be faster. But other than that, like this is fine. And then if you scroll to GIS again for the PE ratio, that's 13.9, and that gets you to 13.9 times. Cool. So now we want to calculate the median and the mean of each. So if you click median of these three numbers, that gets you to 11.3 and 20.6, and then mean or average, average of these three, you get 13.4 and 19.1. So I know you're just averaging the comps. The Kellogg multiple is just there for like visual comparison, but the actual averaging and taking the median is of the three competitors. Right, so then I have these stats of Kellogg on the right. So their net income and their EBITDA are just, so their net income and EBITDA are 864 and 2370. So you can see here that this is their stats that we will use, the earnings metric we will use for their comparables. Right, so first we want to calculate the implied equity enterprise value. So we don't need to do that for PE because we want to just get price over earnings, your equity value directly. So for this, the implied equity enterprise value is you take the EV over EBITDA multiple, and then you multiply it by the EBITDA of Kellogg's last 12 months. And it's helpful to lock it in with the dollar signs, so we can just copy and paste the formula to the mean and median. So enter that, you get a mean enterprise value of 26,781 million, which is 27 billion. And then if you control D, because we locked it in, you can see that the EBITDA stays the same cell, and then you move down to the mean for EV over EBITDA.
I think it's switched, right?
Is it?
Yeah.
Oh, wait, sorry. Okay, that's my bad. So in this case, just change this. So everyone changed their Thanks for catching that.
You do control or option?
For the Mac, I believe it's Command D. Is that a thing? The other thing you just do, you can just Control C and Control V. That works too. Or Command C, Command V. Cool. Right. So again, this is their enterprise value. And then we don't need to do it for PE because PE is already an equity value. So then, because we're trying to ultimate goal is to get to implied price per share. So that means like so the goal is to get to implied price per share. So now we have this enterprise value metric, and we want to convert that back to equity value. So who remembers the formula for going from enterprise? Who remembers the formula for enterprise value?
Equity value minus cash plus debt plus
Correct. So then you want to go to get from enterprise value to equity value. You basically flip that around. So it's equity value is enterprise value plus cash, and then minus debt, minus preferred stock, and minus non-controlling interest. So basically here you want to take this, and then you want to minus. Okay, so essentially, so basically your equity value is just equity value plus these three things because the cash is negative. So that means to get from enterprise value to equity value, you just take this, and then you subtract the sum of these three things, and then you lock it in for the other calculation. It's reserved to 430. So this calculation basically gets you from enterprise value, then you subtract out the sum of this. So you subtract out debt, and then you're subtracting negative cash, so you're adding 340 in cash, and minus non-controlling interest. And Kellogg's has no preferred stock, so that's why it's not there. And that gets you to $16 billion in equity value. And then if you drag it down, again, since you lock the other cells in, you have that. So that the mean is that. Cool. Does that make sense?
What did you do last part? You dragged it down?
Or if I drag it down, I mean just control the copy the formula over. Yeah, you copy the formula over from D15 to D16. Yeah, and since we locked in the cells on the right, we basically that's why the copying the formula works, because you shift the cell on column D, but you don't shift the cells in column H. Yeah, and then for the price of earnings ratio. Because earnings ratio is price per share divided by earnings per share, and earnings just net income. So if you multiply, this just means you're willing to pay this amount per dollar of earnings. So that means if you multiply it by your earnings, which is your income, which is 864, it allows you to arrive at your equity value. So from this is just your median times your net income. And oh sure. Whoops. I pressed F1. So that gets you that. Yep. F4. Yeah. You press F4 once, that gets you 2. You press F4 a second time, it removes one of them. You press F4 a third one, it locks the other. It locks the other, like the letter, and then you press it again, it goes back to nothing. Right, so that gets you 17 billion. And then this, you can just copy the formula over, and that gets you around 60 million. Cool. And then you have meeting, okay, you have that again. Oh. So now you have your equity values. So this is your market cap, which is the total value of all equity. So that means you just divide this by your fully diluted shares outstanding, which is the number we calculated for Kellogg's on the Kellogg's tab, which gets you, which is 342.3 million shares outstanding. So you basically just copy this formula. Oh shit. Yeah. So you want to copy this formula across. So you can see that they're all linked to H10, but the cell they reference on the columns D and E changes. Right, so now this is done. We got implied share. So these are the implied share prices based on the competitors. As you can see, if you go to their share price of yesterday, it's $61.43. So based on these three comps, you can see that in general, this would produce the result that Kellogg's is overvalued. Because the implied share price from its competitors is lower on the whole than than Kellogg's, with the exception of the mean. But if you look at this, you can see that Mondelez definitely skews results with their somehow absurdly big 18 times EV over EBITDA. And if you look at the multiples as well, it makes sense because Kellogg's has a higher PE ratio than the other three. So therefore, it would seem that they are overvalued relative to the peers, because for some reason people are willing to pay $24.3 for every dollar of earnings, but they're willing to pay less for the other companies. Cool. So that is comps. Anyone have any questions? Well, it looks like no. You all are to be smart people. But so generally, we only use mean and median here. Normally, you'll have more companies than this. Or you should have as many. You should have like obviously more the better, but also you want ones that are quality and make sense. So if your company does not have a lot of comparables, then you only use the ones that make sense and don't really use the ones that don't make a lot of sense because that skews results. You might, if there's only one or two, you might want to use a bit more and just be like, this is just for analysis. There's obviously imperfect because of the lack of comps. And if you have a lot of good comps, you should definitely use all of them because the more companies, the better, and gets you a more accurate gauge of your specific company. And once you have more, people also take the max, the minimum, the median, the 25th percentile, and the 75th percentile, just to get like a larger spread of numbers. So that gets you like a larger spread instead of just like a ballpark number from the mean or median, and that allows you to construct bars on like a football field. But other than that, I think that's it for today. So I know I'm very late getting back to you on your accounting assignments. I promise I'll do that this week. For last week, only one person sent their stuff in, but that's okay. I would like last week just for practice, but I think this week it's more like tangible in the sense that we actually did it properly. But for next week, I would like you all to get a head start on your pitches. So basically, suggest some comps, at least 3 for the company your team is looking at, and then provide a reasoning about why it's a good one. For each company, provide reasoning why it's a good comp, and also a few potential downfalls of the comp itself, in terms of why it might not be the best comp. So this, yes.
like half IQ that shows like the neighbor and the
Yeah, so to show you real quick, so, let's say like, let's just do like Apple. So you can see here for Apple, there's like, it's in the financial/valuation section. So this is your historic income statement, blah, blah, blah. So to show you all how I got LTM, so it shows you LTM here. So this is just taking the last 4 quarters of data they have and adding it together. So that's where they got the LTM number. And then in terms of multiples, that's here. As soon as this loads. But yeah, here are the multiples. Yeah. For the things in the future, so I'm not too sure actually what these mean. I think the close seems to be what you want, because that's like the ending multiple. The others seem to just be analyst considerations. So basically, like, to put it in context, things like October 24th, the data is not out yet. But like, these are basically the CapIQ's aggregation of equity research reports and what analysts expect them to be. So I'm pretty sure I've used FactSet this summer, so FactSet is a lot more clear than this. But I think the close is the actual one that they ended the quarter with, and these are the average high and low are the analyst projections at the time when this was in the future, and analysts projected the average analyst projection was 3.73, the high was 4.56, and the low was 2.80, and it turned out to be actually 3.0. So I think you want to use this close. I will double check that in terms of how CapIQ actually works. But like, just keep in mind that like things that are projected are like them aggregating equity research reports. But in general, like for the most perfect comp, you want to calculate everything yourself, kind of how we calculated it with General Mills. But like, if you need something quick, then just pulling stuff off of databases is fine. Cool. Any other questions? Cool. That's all for today. Just send me your assignments for suggesting the comps for your team, and also feel free to CC your sector director. They'll be very impressed.
Thanks, Welby.
No problem. Have a